Hi, this is Ronald, and welcome back to Lern. Today we're going to talk about a subject that's become somewhat near and dear to my heart lately, personal finance. Now, I by no means claim to be anything in the way of a finance guru or anything, but the more I learn about finance, the more it shocks me that this stuff hasn't been taught in school. Like, almost not at all. Which really baffles me because as a kid I remember we were all thinking about math in terms of when exactly am I going to use all of this? Well, honestly, personal finance is a perfect example of when you're going to use all of this in a daily, everyday sense. It's really a good way that they could make us care about basic math when you were younger, or at least give us a reason to care. It makes a lot of stuff relevant because while it may be true that you can always have a calculator there to help you, you need to understand some of the basic mathematical operations to really get a sense of what you're doing with that calculator. In this episode of Learn, we're just going to scratch the surface of what I think a curriculum on basic personal finance should cover. And in future videos, we're going to cover some of the more advanced concepts in the financial sphere. To start, we'll cover just two concepts that are so basic that I really feel that we have no excuse for not teaching them in school: credit and the stock market. Two concepts, but as you can see from the length of this video, we'll have plenty to talk about. One takeaway I can give you right from the beginning: for most of us, investing in the stock market is not optional. Keep watching to find out why. But first, we're going to talk about Now, growing up, I don't feel like I got a good understanding on what credit was and why it's important. My parents mentioned that they had good credit in passing, but seeing as I had no idea what that was, I never really cared. I mean, if it was that important, they'd teach me in school, right? Now I've come to understand that credit is absurdly important, and the fact that kids are never formally introduced to the idea is absurd. Credit is an invisible force that can dictate where large chunks of your future earnings will be spent. I used to think that if you used a credit card, you were actually being irresponsible by not just paying for everything up front with the money that you actually have on hand. When I started making my own money, I wasted a lot of time using a debit card only. I was lucky enough that my parents added my name to a bunch of my loans and stuff that they helped pay off, so I was able to start out with a decent credit score, but I wasn't doing myself any favors by not building my credit history. I just recently kept my brother from making the mistake of paying for a car up front in cash, which he likely thought was a prudent idea. There's a lot of simple mistakes you can make in life just by not knowing how credit works. And it's scary because your credit can take a hit without you knowing until you finally decide to look it up, and the damage is long done by then. So, what is credit? And what's a credit score? Credit is kind of how it sounds. How much credit should a borrower give you when deciding how likely you are to pay back a given loan? This is huge because whether you realize it or not, there's a lot of things in life that you'll end up financing with loans or otherwise being screened on the basis of your creditworthiness. Unless, of course, you're starting off rich, in which case, lucky you, I guess. I'm talking about things like financing higher education if you're taking out private loans, the interest rate on your auto loan, the interest rate on your mortgage, whether a landlord will rent to you at all, getting better credit card deals, and some employers, controversially, have been known to look at modified credit reports during the hiring process. Cell phone companies can screen your credit before offering you certain plans. Banks will generally look at your scores before they let you open an account with them. And how much do you think they'll make you pay to insure your car? Your credit score factors into a lot of these things. And like, for instance, that car payment, that's another monthly, potentially non-negotiable cost that you have to pay. Now, let's just agree right off the bat that these costs can add up to a massive amount. In your head, you probably have some idea that this must be true. But what you may not realize is how big of a deal this can become. Let's just take one of these transactions as an example: your mortgage payments. A mortgage is a loan from a financial institution, typically a bank, that lets you buy a house without having to pay massive sums up front. Your dream home in a good location may well be hundreds of thousands of dollars in value, and you may be able to finance that, but only over a decade or three. As you can see from this example on myfico.com, for a $216,000 loan over a 30-year fixed-rate mortgage, your monthly payment can go from as little as $879 if your credit score is amazing, to as much as $1,071 if your credit score is at the absolute bottom of the allowable range. And by the way, there is an allowable range. With a low enough credit score, you may not even be able to qualify for a mortgage. You may be deemed too much of a credit risk. And in this example, a person with an excellent credit score is paying over $2,000 a year less than the one with the abysmal credit score. If we extrapolate that out for the full 30 years, that's over $60,000 cumulatively over the life of the mortgage. The lifetime earnings of the average American, based on a yearly average income of about $31,000 in 2016, but let's call it $35,000 to be generous, because actually at this point it is slightly higher than that in 2020, comes out to around $1.4 million. Assuming for a moment that you are the average American in 2016, that's up to a little over 4% of your lifetime earnings extra locked into a mortgage based on one number. Well, it's actually three numbers, so let's talk about that. The range for credit scores is from 300 to 850. These scores, the ones most people are using anyhow, are more accurately called FICO scores, the FICO standing for Fair Isaac Corporation. Fair Isaac Corp introduced the scores in 1989 as an industry standard that are supposed to make things easier for both lenders and consumers. The system's really only been around for about 30 years at this point, but it's already become kind of the default way that we derive creditworthiness. Now, it's not that it's really only one way, mind you, as methods of calculating a FICO score have been updated periodically since then, and FICO, as Fair Isaac Corp is now calling itself, has introduced many alternative scores since then, like FICO Auto or FICO Bank Card. Who actually comes up with these scores? Well, there's three credit bureaus that are in charge of this, and you've likely heard of them at some point: Experian, TransUnion, and Equifax. Why might you have heard of them before? Well, it might be because you saw one of their commercials. Unfortunately, it might also be because one of them got hacked and they contacted you to let you know that all your data belong to strangers now. Personally, I relate to both of these experiences. Fuck you, TransUnion. If you watched Last Week Tonight with John Oliver, he's done episodes on credit reports and one specifically about Equifax. Highly recommended if you like an expanded introduction to credit bureaus and the various problems associated with them these days. Now, how do you know what your credit scores are? Well, there's a couple ways. First, you can buy credit scores from the three bureaus listed above. Next, you can use a free credit scoring site. And lastly, you can potentially find scores on your most recent loan, credit card, or bank statements, as these institutions have started providing scores in many cases. When checking credit scores, what's the difference between a hard inquiry and a soft inquiry? And why does this matter? So this kind of relates back to the idea that some people have that checking your credit score may be disadvantageous. First, you got to know that there are two basic scenarios where your credit score will get checked: in relation to an actual credit application and not. When there's an actual credit application involved, they call that a hard inquiry. When there's not, like for instance, when a credit card company checks your credit to pre-approve you for an offer, they call that a soft inquiry. A hard inquiry can affect your credit score, typically negatively. Too many applications for credit in a short time can be seen as risky behavior that might be seen as you trying to live beyond your means and struggling to pay. Now, to distinguish between people shopping around for a good deal, which is a good thing, versus these more reckless types, they look more negatively on people applying to credit on a bunch of things than people doing hard inquiries for various products of the same type. These stay on your report maybe 2 years or so and become less of an important factor to the score itself over time. Multiple inquiries won't hurt your score for 30 days or so. So shopping around in the space of a single month isn't restricted. So this is part of how they actually tell the difference between those two different groups. We can take some basic lessons from these conditions. You should only apply for credit when you need it. Check your credit reports for hard inquiries and make sure you recognize the inquirer so that no misunderstandings or fraud get onto your score. Something like 20% of credit reports actually have some errors on them. So look at them regularly and make sure you recognize everything. Don't space out your shopping for loans too much, as you may end up peppering your credit score with inquiries for the near future. It's important to take a look at your reports regularly, perhaps at least once a year, and make sure they're accurate, as these are what your credit scores will be based off of. What's on a credit report? Well, first you'll see your identifying information and personal details. Then you're going to see your various accounts: student loans, mortgages, auto loans, credit cards, etc. There will be various details regarding payment history, credit limit, loan amount, date an account was opened. You'll also see all hard and soft inquiries, which will be labeled as such. They'll be keeping track of any bankruptcies or accounts that have been turned over to a collections agency. A FICO score itself, and not all credit scores you see are true FICO scores, is calculated by mainly 5 factors, each of which has sub-factors that we're going to talk about in a minute. New credit, mixed credit, length of credit history, payment history, and credit mix. So a person with a high FICO score, credit score will have a long history of making payments on credit, a history of making credit payments on time, not too much new credit or not too many new accounts, and a decent mix of credit types that they're handling the payments on well. Now, note that the percentage on this chart are kind of more averages and don't necessarily hold true for most people. Your new credit may be weighted higher given your history, and maybe you're just starting off, so payment history is weak, but you happen to have a solid job early on, so they don't dock you as hard. What's the difference between a credit report and a credit score? Well, credit reports, of which you're entitled to a copy from each bureau every year for free, don't necessarily have your credit score on them. If you open an account with Equifax, they will give you up to 6 free reports per year. When we talk about new credit in a FICO score, we're looking at 5 things. How many new accounts in the past 12 months and the proportion of these accounts that comprise your total, your recent credit inquiries, how long it's been since you last opened a new account, how long it's been since your last credit inquiry, and the reappearance of a credit on the credit report of positive credit information for an account that had earlier payment problems. So there's a few caveats in there to the idea of new credit being bad. Paying off your delinquent accounts actually appears as new credit and helps you improve your score. Furthermore, if adding new credit to an existing line of credit decreases your overall credit utilization, this can actually be a good thing. New credit typically comprises a small part of your overall credit score. When we talk about mixed credit in a FICO score, we're talking about how well you manage having different types of credit. Revolving accounts versus installment accounts and loans for various different asset types. It looks better if you have a few different types of loans and are paying each of them off on time consistently. It looks bad if your credit mix have gone up considerably in a short amount of time, as it kind of tells people that you're overspending and you can actually get denied for a loan because of that. Credit history is a big one here. A longer credit history is generally better. It shows lenders that your patterns over time and gives them a clear idea of who they're dealing with. This one's really kind of clear-cut, and it's an area that, like I said earlier, I dropped the ball on for a while. For the teenagers out there, get a credit card as soon as you're able. Seriously, even if you don't really use it much, just make sure you pay on time and don't carry a balance, and you should be good on building the length of your credit history. Amount owed is going to factor into your credit score kind of exactly how you think it would fit in. Owing more money is typically worse for you, but it's not necessarily the end of the world if you're good for it. If, on the other hand, you owe a bunch of money and you're utilizing a large proportion of your maximum credit, that's a problem. If your debt-to-income ratio is huge, like mine is after Uncle Sam helped me foot the bill for medical school, you may have trouble getting more credit or finding a place to rent. You may end up needing someone to co-sign things with you for a while if things get out of control, and who wants that? So what goes into a credit score, and what does your individual number mean? Well, the average American has a credit score around 680 or 703, depending on who you ask. So if you're below that, you are, by definition, below average, and are therefore a relatively risky person to give money to or extend credit to. Below 640 is typically what we call subprime borrower. Quick side note, yes, this is essentially what the subprime mortgage crisis was about back around 2007 to 2010. Predatory lending practices expanding mortgage credits extending mortgage credits to high-risk lenders was a big problem, although it wasn't the only factor. Around 670 to 740 is what we call the good range, which is basically when you're about average creditworthiness. Above 740 is where the really good stuff starts to come in as far as interest rates and offers. If you can get into this range, or better yet, above 800, you're likely to get the best rates for all your transactions involving credit and can save yourself, as we saw in the example earlier, tens of thousands of dollars or even hundreds of thousands of dollars over your lifetime. And you'll have access to better credit cards, which you can use for cashback rewards or travel rewards that can help you get even more for your money. Now, one thing you'll notice if you take a moment to look up your scores is that you probably have 3 different numbers. Why is that? Well, not all the same credit information may be reported to each bureau. Also, these reports don't necessarily reach each bureau at the same time. If you've applied for credit under different names or misspelled your name on a credit application, this may not show up in your reports consistently. Also, each agency will calculate your score a bit differently. As I mentioned, not all scores are FICO scores, and you may come across things like the Vantage score as well as your typical FICOs. Fair Isaac itself offers dozens of different scores like the FICO Auto score that weight factors differently. In short, your credit score is important because you can save or lose a lot of money throughout your life because of it. You don't get to opt out unless you're rich and don't really care about or need credit, so you may as well play the game. Credit bureaus calculate your credit scores based on credit reports. There's a bunch of different scores and reports. High number is good, low number bad. Make payments, make them on time, don't engage in risky financial behaviors. Simple. Hey you. Yeah, you. Do you plan on retiring at any point in your life? Like ever? Ever wondered how the logistics of that might work out? Like, if you retire, you're not going to be working a job. Assuming that you're like most people and have only one major source of income, a problem that we'll tackle on Not Learn later, that means that you won't be bringing in any new money. And if you don't bring any new money in, you'll be using what you already have until you die. So you better have a lot saved up by the time you get to that point. So how much? Well, that's a pretty good starting point for what I want to do first. First, I want to convince you that investing in the stock market is, for most people, not optional if you plan on retiring at any point. How much you end up needing for retirement depends on how much you anticipate spending during each year of retirement and how long you estimate being retired. The average American lifespan is about 80 if we round things off. So say you retire at around 62, which is roughly the average for Americans at this point. That means that the average person can expect to roughly 18 years, let's call it 20 for the sake of keeping round numbers, of retirement before they die. Now, let's say that you want to retire on $50,000 a year. So that's $50,000 times 20 years, coming out to a clean $1 million. That is not factoring in inflation during those 20 years, of course. That's one way to estimate. Thing is, there is going to be inflation during that time. That's going to devalue your money by usually around 2 to 3% every year. And you really do have to factor that in. Also, you got to expect that as you get older, your health will decline, especially if you're not in the habit of taking care of yourself. And those costs can become mountainous. So a common rule of thumb that's used here is the 4% rule. Plan to have enough of a nest egg that your planned yearly expenditure is 4% of your total. So in this case, if we wanted to spend $50,000 a year, we'd want to build up about $1.25 million in investments. If you're retiring early, which we'll touch on in a minute, you may want to use more like a 3% rule if you anticipate being retired for longer. Or build even more of a cushion in if you prefer to be over-prepared for any curveballs life throws at you. So now we have a ballpark idea of how much we'll need. How do we get there? Let's go back to that idea just now. Inflation is going to devalue your money every year that you hold it. So if you're going to hold it, you need to find a way to do that in such a way that you get returns to offset the effect of inflation. Otherwise, you're actively losing money. The national average interest rate on a savings account in 2020 stands at around 0.06 APY, or annual percentage yield. But you can get rates as good as 1.5% in high yield savings account if you shop around and you qualify. The average long-term inflation rate has held between 2.3 and 3.2%. Even on the low end of that, the money you keep in your bank account is not returning enough to keep up with inflation, and over time its buying power will decrease accordingly. Moving on from bank accounts, consider the least risky place to store your money to money market accounts or money market funds, which can be thought of as the second riskiest place to store your money, have higher interest rates with often almost comparable security, but the best of these will give you only around 2% interest. So really, you're still losing money here. Now, we won't touch on financial products like certificate of deposits in this video, but you get my point. Most of these common ways to store or invest your money won't net you enough return to beat inflation. Stocks, however, are quite likely to help you beat inflation with some very basic know-how. The average annualized return for the S&P 500 for the past 90 years is 9.8%. Real estate investment, a generally more active enterprise, is also likely to help you beat inflation. In fact, there's actually a couple ways that you can beat inflation if you're keen on having a selection to choose from, not least of which is simply having a larger income shovel/day job. Once we've established that there are certain avenues that we can use to beat inflation, we need to start thinking about how we can beat taxes. Because remember, all of this gets taxed. Uncle Sam always gets his cut. You don't get to just walk away with free money. Everything gets taxed. Then we start talking about accounts that we can hold these stocks in. Everything from 401k/403bs with employer match to health savings accounts to Roth IRAs. And hey, don't some of those sound familiar? You may have heard your parents or friends talking about them at some point. What even are these accounts? Well, they're just what I said. Ways to stave off the tax man. When you get a real adult job, your employer is likely to start an account like a 401k, or if there's a nonprofit, a 403b, on your behalf. And you may have what's called a match, wherein your employer puts in as much money into your retirement account as you do, thereby matching your contribution. This is the only vehicle I can think of where people will give you free money, and it's totally not a scam. This is actually a situation where if you put in up to a certain amount in this account, you will automatically double that money, and it'll grow tax-free until you withdraw your money. Now, the catch is that you have to wait until you're at least 59 and a half years old, or they'll charge you 10% on anything you withdraw. The upside is that you can essentially double your money instantly. So naturally, one rule we got to establish when saving for retirement is that if you have an employer match on your retirement account, you should max that out. It's literally free money. Like actually, it really is. Then we hit things like the Roth IRA, which has a more forgiving withdrawal limit of 5 years from deposit and helps you avoid taxes at withdrawal. We also have health savings accounts for which you can only use on medical expenses, which, as we said before, can be very high once you get older, and allow you to make tax-free deposits. Once again, these are different types of accounts with their own rules and regulations, which we'll cover in more detail in the blog. Suffice it to say that these two particular Roth IRA and HSAs are generally good ideas to have and to contribute to with your extra money. Extra money. I'll emphasize that a little bit more later. There'll be some not learned videos on financial products like these in the future, but for now you can learn a little bit more by hitting up my blog for a primer/glossary that accompanies this video. Link in the description. But for this video, I'd like to focus on what these accounts fundamentally do. They allow you to invest in the stock market. That's what they're doing. The amount that you put in is not the total amount that you'll get out. How do you think these accounts are yielding all that money? They are investing your money in the stock market, and that extra yield is coming from stocks, whether that be in the form of dividend payments or capital gains. Retirement accounts will generally be highly diversified accounts that invest according to a pre-planned strategy. Now, note when I say diversified, I mean I'll generally try to invest in companies from different sectors of the economy to minimize the effect of market downturns. Now, if you're going to invest large sums of money in the stock market, I think it follows that you should maybe know a little bit about how the stock market works. After all, you wouldn't buy something on Amazon if you didn't know what it was. Financial products like Amazon stock are no different. So now we're going to go over some basic concepts that we'll expand on in a future video, probably on not Lern. So first off, what is a stock? Well, when a company gets big enough, it may decide to go from being a private company to being a public company. or a publicly traded company. In doing this, it issues shares of stock in what's called an initial public offering, or an IPO. This can help private investors fully realize gains, as this comes with a premium on existing shares. Once shares have been issued in the primary market and the stocks are out there and available, people who got in on the ground floor during the IPO then go and trade those stocks for what's called the secondary market. This is likely where you'll be buying stock if you get an investment account with your brokerage. Stocks are sold on various stock exchanges throughout the world. The NYSE and the NASDAQ are the big American ones, and really the NYSE is the worldwide big boy. The US actually has 13 stock exchanges overall. Fun historical note, the idea of splitting up your company into a bunch of pieces based on how much people put in and how many people took part probably dates back to the 1600s, when European explorers would raise money by selling off claims to a share of their profits. The first modern stock market, however, was the London Stock Exchange, founded in 1773. There are some different types of stock, like preferred stock versus common stock, but the fundamental thing you have to understand is that buying a stock is buying a share of a company. It makes you part owner. Now, you're only a 40 millionth of a percent owner, but you're there. You got a piece of the action. When you buy a stock, you are essentially voting your confidence in a certain company using your money. Now, understand that stock prices are not necessarily tied to the intrinsic worth or productivity of a company. They can be very speculative. A single share of Tesla stock is worth about $14.17 right now. With about 180 million shares outstanding, that puts them at a market cap of around $262 billion. So that's their valuation, their market cap valuation. Is that a fair price for them? Are they actually worth $262 billion? Fuck no. Probably not, like at all. So why are people willing to pay so much for a share of Tesla? I have a share of Tesla. Well, I don't have a full share of Tesla, but I have fractional shares of Tesla. Anyway, people all have their reasons, but at the core of it all, it's that they think the price will go up in the future, and it may actually be a deal to buy now. Now, this lets us introduce the idea of capital gains, dividend payments, and PE ratios. If you were to buy a share of Tesla stock at $14.17 and it went up to $15.17, that's a gain of about $100. And yet you don't have an extra $100 in your bank account, because this is unrealized gain. You'd have to sell your share of that stock to realize that gain. This is what we talk about when we say capital gains. This is the fundamental idea behind the buy and hold investment strategy. The strategy that has been proven time and time again to be the dominant investment strategy for the long term. Anytime you're investing in the stock market, you generally want to think about the long game. Because you're almost guaranteed to have periods where you're looking into your portfolio balance and you get nauseous. There'll be bad days, months, and even years. The idea is that as national and global productivity goes up, the markets will only go up, but at least only on average. The debt cycle fueled by the idea of credit will practically ensure large fluctuations, but the trend is assumed to inflect ever upwards as people do more work globally. Now, if stock prices aren't necessarily tied to the value of the underlying company, how do you know what's a good price to buy at? Well, that's actually kind of a complicated matter. One thing to look at is the price-to-earnings ratio. It's just what it sounds like. You take a look at the stock price and you divide by the company's earnings. It's just a value you can Google, so you don't actually have to look it up, but you know what I mean. Mathematically, the question is, how much am I paying for the stock compared to how much cash is this company that I'm buying a piece of bringing in? You may not want to buy an underperforming company for a high price. In fact, you may not want to buy an underperforming company at all, but that's a related issue. You also don't want to buy a well-run company at too high a price. A PE ratio over 20 often means that you're paying too much. I'm usually looking for below 15, but there are caveats to that. We can look at that in more detail on Lern. But keep in mind that a low PE ratio does not in isolation tell you the relative value of a company. For example, if a company's stock price plummets ahead of a drop in earnings, you may think that you're getting a deal, but that may exclude the fact that something huge may have happened to shake investor confidence in that company despite its current earnings. A low PE ratio because earnings are going up and a stock really is underpriced at the moment is really what you're looking for. Now, some companies will actually pay you to hold a stock, which I think is the most interesting part of this whole video. Seriously, they'll pay you at regular intervals just for holding their stock. Some companies will pay you yearly, some quarterly, and some even monthly. For instance, one of my personal favorites, Realty Income, ticker symbol O, has a stock price of $57.42 at the moment, with a dividend of about 23 cents per share. So I buy one share of O, I get 23 cents a month for owning that one share without any further expense or effort on my part. Which sounds pretty underwhelming until you realize that over time, you're going to end up buying hundreds or thousands of shares. Every 100 shares of this stock will get you over $23 a month free and clear. Going further, 1,000 shares is over $200 a month, and 10,000 is over $2,000 a month, or $24,000 a year, at which point you'll have sunk a bit over $500,000 into the market. Returning for a moment to our original example of a person who wants to spend $50,000 a year in retirement, an alternative way of going into retirement is by building a stream of dividend income that covers your costs entirely or in part. If you have a $1.25 million account with a 4% dividend return, you could potentially live off your dividends alone without ever touching your capital. You can keep your original $1.25 million in there and just take off the excess dividends every year. In which case, you could theoretically stay retired no matter how long you lived, as long as your expenses didn't go over $50,000 a year. Of course, dividends can be cut, so perhaps you'd transition over to bond funds or something at that point. Now, one thing you've probably noticed about these savings figures, they seem kind of daunting. I mean, lots of you are probably hoping to live on more than $50,000 a year during retirement, and you might find the prospect of saving at least $1 million to be a tall order. Well, what you got to understand, especially if you're young, is that you've got two big factors that determine how much of a nest egg you end up with: the rate at which you save and the time over which you have to save. Of these two, the biggest factor is generally going to be how long you save. Young people have time on their side. If you start saving early, you'll ultimately end up with more than if you'd waited. In fact, dramatically more. Why? Because of the power of compound interest, a concept that will make more sense now that we've introduced the idea of getting dividends, payments a company will give you just for holding their stock. Take a look at this graph illustrating three scenarios taken from JP Morgan Asset Management. Here, we see the savings trajectories of three individuals, each of whom have invested the same amount per month for varying amounts of time, assuming average market conditions. One of these people saves for 10 years and relies on interest alone afterward. The other two have 10 years difference in their saving history, but contribute the same amount each month anyway. You can see that the one who started 10 years later ends up making substantially less than the one who started earlier, including the person who ended up only making active contributions for 10 total years instead of the like 30 or 40. Now, of course, if you took this example out a few more years, the curves for the lady who stopped making contributions and the guy who started late would intersect. But the point is that starting early is a huge advantage, and making regular contributions is crucial. Look at how much the guy who started early and never stopped made, almost twice the final savings of the second place saver. So how can this be? I mean, the difference just seems so significant. Well, it all comes down to the power of compound interest and the way dividends play into that. See, here's how compound interest is calculated. The important thing to note here is that compound interest payments, that with compound interest payments are not calculated with just the original principal. Rather, they're recalculated using the running total once interest has been added on. Using Realty Income again as an example, right now they pay around 23 cents per share. Over time, they're going to grow it to 24 and 25 and 26 cents per share. Once you've bought around 30-ish shares, you'll be making enough off of dividends to buy an entire extra share each month off of just your dividends. So your shares will be buying more shares regardless of your continued input. Eventually, they'll be buying more than one share at a time every month. And as you put more money in, your expanding total starts to make more money for you faster. This exponential acceleration is what characterizes the miracle of compound interest. Note that this effect is negligible at earlier stages of the saving process, and your first dividend payments will seem a little underwhelming for some time. But if you want to reap the benefits of compound interest, you'll have to just stick it out and keep adding to that nest egg regularly. Here's another example. If you have an account with an initial deposit of $6,000 and you add $4,000 a month for 7 years, assuming the S&P 500 return of about 9.8% over the long term, which admittedly won't necessarily hold for a short term of 7 years. In fact, it's likely not to hold during a short term of 7 years, but more on that later. And monthly compounding, you end up with about $491,095 in under a decade. More important than the final count, look at how that progresses if we carry that out over 20 years. We end up with over 2.8 million this time. But direct your attention to the table form of this graph, where we can see how this ramps up over time. There's about a $50,000 difference between the initial value and that at 1 year, because that's about how much you're going to end up putting in with that base contribution rate. And for the next few years, we see roughly the same thing, just slightly more from year to year. But once we reach even 4 to 5 years in, we start to see this change. Going from year 4 to year 5 is about a $76,000 jump. From year 5 to year 6 is about $85,000. And this ramps up every year until finally from year 19 to year 20, we see a nearly $370,000 jump in a single year, all without ever raising the amount that you contribute each month. You're still only putting in about $50,000 each year, but you're getting so much more out of it. If you started doing this at around age 30, you could have nearly $3 million by age 50. Enough to retire on almost $150,000 a year if you get a little over 4% dividend yield. Taking this particular example out to 30 years, we see that this pattern of saving would yield a final balance of about $8.2 million. Now, reasonable people might point out that $4,000 a month is maybe pretty much untenable for them. Fair enough. A more modest example comes in the form of someone who starts from zero and invests only $1,000 a month. Over 20 years with 9.8% average return and semi-annual compounding, we end up with just over $700,000 at the end of 2 decades. Once again, pretty respectable despite the monthly contribution being significantly lower. And keep in mind, 20 years is kind of on the lower side if we're talking about planning for conventional retirement. If we aren't planning on retiring early and we're going to be reinvesting the dividends, it might be useful to look at this example over 30 or 40 years. So taking this same $1,000 a month contribution schedule out another 10 years under the same assumptions, we end up with just over $2 million. And if we take it out yet another decade, we end up with $5.5 million. And this is just with $1,000 a month and starting from zero. If we go one step lower, and we'll see that it does become harder to capitalize on compound interest if you aren't pumping enough in to begin with, and the interest rate you actually end up seeing makes a difference as well. So starting from zero, contributing $500 a month, and assuming only 7% returns compounded semi-annually, we see that over 30 years, we only get about $590,000. So I'd aim for at least $1,000 a month of contributions if you can, as that same scenario ends you with almost $1.2 million if you simply add the $1,000 a month instead of the $500. And I hope that kind of demonstrates how compound interest, something Einstein called the eighth wonder of the world apparently, can save you uncanny amounts of money over time, and how best to take advantage of compound interest. These scenarios so far have assumed that you're planning on retiring around the usual age, somewhere around your mid-60s. But it's probably dawned on a lot of you by now that there's no reason that this has to be the case. And you're right. You can totally retire long before your 60s. One option is to just find a huge money shovel and get to shoveling. If you maybe start a business or have a really lucrative job, you may have a very clear route to this outcome. Otherwise, you may have to learn to live very frugally and invest aggressively while you're young and willing to tolerate risk. In fact, there's an entire community centered around this idea, the FIRE community, or Financial Independence Retire Early. Some of these people stretch their dollars to where they're saving 90% of their income. We're going to take a totally separate Not Learn video on them soon, as that's really its own world, a rabbit hole within a rabbit hole. If you'd like, you can actually set up investment accounts that are privately run by you and can take advantage of any or none of these tax advantage strategies completely separate from your employer. There's a bunch of different ways to do this, and the number of people getting into the stock market on their own has boomed lately. Large swaths of the personal investing market are facilitated by companies like Robinhood, Webull, and M1 Finance. The ones listed above are free financial apps that anyone can use to invest in the stock market. I know Robinhood and Webull offer free stocks just for signing up. I personally use M1 Finance, and at some point, we'll be taking a look at my investments therein in a detailed way. All three have commission-free trading, meaning that buying and selling stocks is free. I know at least Robinhood and M1 have restrictions on day trading, unless you upgrade your member. Never personally used Webull. Actually, let me know what you think about Webull in the comments below. I find it intriguing as it is this feature that lets you start and track a fake portfolio with imaginary money, just to get like a dry run on the market, which I think could be really valuable when you're first starting out learning what you're doing. I think that a company that comes up with a sensible idea like that might be well run in other ways. Another question you probably have at this point is, when do I buy a given stock? Just when the PE ratio is below a certain value? Well, you could set things up that way. And making sure you pay a reasonable price for everything you buy is certainly important. You could do in-depth research and try your darndest to time the markets, trading at higher frequencies so you can make the most of market dips and rises. But you'll likely end up with less return on average than if you'd simply dollar cost averaged your way into the market over time. Dollar cost averaging, or the constant dollar plan, is when an investor simply makes periodic purchases of target securities over time instead of trading larger sums all at once. It's meant to or larger sums or just really small sums timed a certain way. It's meant to minimize the effects of short-term volatility. Of course, you actually may not get as high a return as if you'd made larger lump sums investments, but this is the trade-off for less risk. Now, with the assumption that your investment grows in value, dollar cost averaging reduces the effect of low points in the market, increasing your return over time so long as the market goes up. Note that this doesn't protect you if your stock picks lose value over time, which is why diversification in the form of ETFs can be so handy for people on the constant dollar plan. This is essentially how your 401k or 403b likely works. You're just making constant contributions in a highly diversified portfolio that allows you to minimize your downside and dollar cost average into the market over time. And, you know, of course, if in the future we run headlong into conditions where long-term market growth can no longer be assumed, which may happen, a lot of this stuff won't function quite the same. But in the decades since the Great Depression, the markets have followed a general upward trajectory. Specifically for those of you who would claim that you don't have enough money to invest, I'd say that's probably nonsense. At the very least, you can set up automated contributions to your employer match before ever actually getting that money in your account. This will lessen the feeling of loss since you're never actually getting that money. But if you feel like even that's not an option, there's always apps like Acorns, which, again, I personally use. These apps do things like investing your spare change from purchases. For instance, if you buy something for $1.50, it invests the remaining 50 cents, on top of a user-selected scheduled contribution as low as $5 or even $0 if you're being very conservative, allowing you to gradually build up savings until you're in a position to make more sizable contributions. Unless you're really struggling, you should really be able to invest at least a little bit. Which brings us to our last point here, which really supersedes a lot of these things. Don't put money into the stock market if you think you'll need it anytime soon. The strategy of investing that's been shown in studies to outperform others in the long term, as I said before, is buy and hold investing. You buy a company /ETF /index fund or whatever, those fundamentals you believe in, and hold it for the long term. Making frequent trades, buying and selling perhaps multiple times a day, is called day trading. And it's really more a form of gambling than actual investing for the vast majority of people. Just don't do that, all right? Investing shouldn't be gambling. And Warren Buffett's number one rule for investing is don't lose your money. His number two rule, don't forget rule number one. So, you know, if you're constantly realizing losses in gambling, you're doing it wrong. That might be fun for you, but let's not mistake that with actually investing. This leaves us in a position where any money we put in the stock market is essentially lost for a long time. You got to anticipate that and be able to weather the storm. So there you have it, a bare-bones introduction to personal finance. To recap, credit is almost a fundamental fact of life, like death and taxes. The stock market is most people's only chance of retiring on time. Bad credit can weigh you down your entire life. Good credit gives you a little extra wiggle room for spending and saving. Money sitting in your bank account long term is actually going down in value, even if the actual number is going up slightly or staying the same, because those interest rates generally don't keep up with inflation. Different types of retirement accounts are ways of beating the tax man and really maximizing how much you have when it's time to retire. Don't put money in the stock market if you're going to need it in the short to midterm future, but do prioritize starting to save early. As always, don't forget to drop a like if you got value out of this video, and subscribe and hit that bell notification button if you'd like to continue our broad exploration of reality and see more educational content like this. We'll have a corresponding blog entry, link in the description, that I'll use to elaborate a little further on some of the concepts introduced here. And head on over to Lern, where we'll have follow-up videos to all the big Learn segments at shorter intervals. I'll have a lot more to say on investing, COVID, fitness, diet, finance, a lot more over there. That's it, guys. Glad you stopped by. We'll see you again in a month or two.